Hello and welcome to NDTV Profit. You're watching Bankable, the show where we're discussing with bankers across the Indian ecosystem to try and understand exactly how they are seeing the current business environment, what they see as potential future challenges and opportunities, and what's actually making them tick. Now, today, I have the pleasure to have Mr. Sudipta Roy, the MD and CEO of L&T Finance with me. Mr. Roy, welcome to this conversation. I'll tell you, it's a pleasure to always see a CEO with a beard because it's so rare. But let me first start with the kind of conversation that we want to have on this program, which is with respect to L&T Finance's transformation from being primarily a wholesale lender to now 95% retail is about the last number that you reported. I know this preceded your entry into the company, but then what was the thought process then, and what is the thought process now with respect to that?
Yeah, as you would probably know that the Retailisation thrust came under the Lakshya 2026 strategy, which is Lakshya is a group-wide strategy that L&T Group follows for most of its independent companies as well as the group, and we were part of the Lakshya 2026 strategy, in which the decision was taken that the company will transition into a fully retail company. The genesis of this was that, originally L&T Finance, if you look at the trajectory from 2014, 15, 16 onwards, was more of a wholesale and rural retail sort of focused NBFC. And somewhere during the IL&FS crisis period, as well as, a couple of the other liquidity issues that the industry went through, and also the slowdown in the commercial real estate sector, made some of our assets have a performance trajectory or a credit performance trajectory which was lesser than acceptable, right? So we made a decision, and our chairman, when SNS became the chairman, he together with the other board members made the decision that we will probably defocus the wholesale business and focus more on retail. We were already doing a lot of retail on the rural side. The fallout of the decision was that our urban side also got ramped up, right? And we started growing both sides of the customer ecosystem, both the rural and the urban, equally strongly. And as we ended last quarter, we are at about 95% retail. We have a very small portion of about 4,400 crore out of wholesale, residual wholesale book left. Now, those are all standard assets. We are not in a hurry to pay them off. And if we find a good valuation, we'll pay them off. Otherwise, we'll let them run the course of their amort schedule, right? And so as at 95%, we are a retail NBFC right now, right? And though the original target was exit FY26, we would be about 95%, but we are here 2 years early. Yeah. So we are hopeful, but that the time we are near exit FY26, right, we'll probably be closer to 100% and have made the transition to a full-fledged retail NBFC as envisaged by our Lakshya plan when we did it in April 22, will be fully delivered by the time we exit FY26.
So now that you are 95%, I'm assuming the majority of the retail anyways would have started early 22, 23, right? So the question I had was with regard to how does this now move forward, right? So you've shared your wholesale identity, entered this retail space. What do you want to do within retail? How do you want to position yourself?
Yeah, so if you see in retail, we have a couple of lines of business which I like to call as our fulcrum businesses. Now, for example, every organization has their own fulcrum business or their areas of strength. If you look at our area of strength or the business lines that we understand very well, first is the rural group lending business or the microfinance business as it is popularly known. We are almost touching 26,000 crore book. It's a very large part of our balance sheet size. And this is a business that we have been present for over 10 years now. So this is a business that we understand very well. So one of our objectives is to build this business to even larger scale, right? Obviously on a risk-calibrated fashion is what we would like to do. And so what we are doing right now is that we are moving into new geographies. We are moving into Western UP. We have just recently started Telangana. We are expanding our distribution in microfinance in Gujarat, in Maharashtra. And so apart from the traditional states where we are very strong, which is, Kerala, Karnataka, Tamil Nadu, Bihar, to a certain extent West Bengal and Orissa, these are the states that we are very strong. We are moving into the other geographies as well, so that this business becomes much more broad-based. So that is one of the focus areas. Also, because we are so strong in rural business finance, as we call it, some of the contiguous lines of business are being built. Though it is probably not apparent yet, but our micro loan against property business got launched sometime last year.
Okay.
We did a pilot in Tamil Nadu, and the pilot was quite successful. We have over 30 branches or micro lab branches in Tamil Nadu, and as we speak, over the H2, we'll be scaling up the micro lab business in Maharashtra, Gujarat, Telangana, and Karnataka. So these are the where then this is a new line of business which is coming in. Our tractor business is a very large business for us. In fact, we are one of the market leaders in tractor, and in terms of the tractor financing business, last year was a bit sluggish because of the bad rains, but this year we have hope on the back of the good monsoon so far, and if the trajectory of the monsoon continues so far, we are hoping that this year the tractor business will give us good results as the sort of the festive months kick in. Already we are seeing sort of a lot of pent-up demand has been there, and we are already seeing some of that demand translating into sales. The third fulcrum business that we have is our two-wheeler business, and in two-wheeler business we are again one of the market leaders in the two-wheeler business. We are approximately about 6% of all the vehicles sold in the country. We finance approximately 6%, and in that business, if you look at same time last year, we were clocking anywhere between 500 to 600 crores of top line disbursements every month. As we speak, we are clocking anywhere between 850 to 900 crores of disbursement every month. So we have grown the business by 50%. And the fact is that in this business, we have been focusing on quality. We have been trying to make a shift to more prime customers. Our prime customer throughput in this business stood at 52%. So our objective is to also, grow this business strongly forward and see if we can gain leadership position in this business. There are other lines of businesses that we are building. As I told you, in our urban businesses, we started our urban, apart from two-wheeler, we started our urban businesses. Many of them have been started recently, maybe in the last 4 or 5 years, right? So in terms of scale, we are yet to reach the scale where, we are either, among the top 3 or the top 4 in the market. But we are investing in all those lines of business. Mortgage and loan against property is a very large line of business. We launched our complete home loans proposition. Again, you asked what is the sort of the plan. Our plan is that we know that we are in a crowded market, and financial services at the end of the day is in the business of lending money, and money at times is commodity. It's money at the end of the way, right? So obviously, scope for differentiation in financial services at times is limited, and most people, for example, the mortgages product, most people sell on basis of rate, right? What we try to do is that we try to look at white spaces in that proposition, and that's why we positioned a complete home loan product in such a way that it has a complete digitized journey. It covers a hitherto uncovered space of home decor finance, an integrated home decor finance option within it, and last but not the least, a dedicated RM for people who are. So our objective is that as we go through the journey, we will try to reinterpret some of these products and try to make sure that we cover some of those white spaces and reposition these products. Because we are coming from behind, especially in urban products, we need to make sense to the customer that we are bringing something new. So that is actually the focus of sort of the process of building our urban lines of business and consolidating our existing rural lines of business as well.
Okay, let me break this up a little bit and try and understand how exactly you're going about this entire plan. Lending, let's keep that on one side because I want to tackle that with a few other factors that might be affecting it at this point in time. But underwriting, let me come to that. Right? That's something that your regulator has constantly been saying, listen, the growth is too high, so tighten your underwriting. Raised risk weights, then constantly advising banks and other lenders to look at this. You've done something on the underwriting side. That will be the next question. But for now, how are you seeing underwriting in the ecosystem? Do you think that the market is playing it a little fast and loose?
See, what happens is that, and I've been around in sort of the asset side and the lending side of the business for like over 25 years now. Right. So, and I've seen good days, I've seen bad days, right? One of the things I can tell you that, when we saw the aftermath of the global financial crisis around 2008 to 2010, when many of the large lenders in the country were impacted by sort of a credit crisis, the underwriting standards that existed at that point in time and the underwriting standards that exist right now, there's a heaven and hell difference, right?
Okay.
For example, taking full income into consideration or taking imputed income into consideration, trying to see whether you are taking all the leverage equations into consideration, whether you're looking at maximum unsecured exposure, or what you call MUB or ADB, aggregate debt burden, or FOIR, as many of the other sort of nomenclatures of that particular things go. I think this is ingrained into most players in the business. So in terms of, I think, the overall quality of the assets in the market and the overall health of the sort of the retail assets in the market, I would say that it is fairly well administered. And the stress testing of the quality of underwriting and the quality of sort of asset buildup in the country was done during COVID, right? And COVID went into crippling disruption between 2010 and 2022. And frankly, losses were elevated. People took provisions, people took preemptive provisions, people took overlays. But the fact is that no organization came to a precipice saying that, because of credit losses, we have dangers of being seizing as a going concern. Right? So I think that was the first acid test. So I would like to say that, yes, things are stable. However, I also do believe that, risk always comes from areas where, are blind spots.
Correct.
Right? And there has been quite robust lending in the country, but there has been, in certain pockets, there has been a little bit of, I would call, overcrowding of lending, right? The places where there has been overcrowding of lending, especially say in the unsecured space, credit cards because of some structural reasons, personal loans because small ticket personal loans on the lower end of the spectrum were done with what is quote unquote called algorithmic lending, etc., and all that stuff, right? Some of those are seeing risk on the margins, right? And it will continue to play out for some time. However, I'd like to qualify my statement that is it something which is widespread and pervasive and will pose as a threat to the system? Whatever data is available with me right now, I don't think it's that. It will be some risk on the margins. There is talk of some of this lending on into the markets, etc., where people have borrowed to leverage themselves in the equity market. It always happens on the margin, right? I think the regulator is pushing on lenders to assert an end use, and I think it's also a step in the right direction, right? So I do believe that the ecosystem is strong and stable. There is some risk on the margin which might play out, but overall the structure is safe.
Do you think that maybe one of the reasons is because the nearest sort of comparative number on the high risk, how you define high risk, the comparative number is from your GFS, the global financial crisis, GFC, global financial crisis, right? And maybe that was an outlier versus what typically cycles would throw up as high risk. Do you think that is getting a little bit sort of hidden, because 2% is considered to be a good number in retail.
Yes.
But then for some lenders, 2% might be a bit too high, or I don't know. Then comparatively, 4% is not that high.
Yeah. So you see, again, lending is always a business of adverse ratios, right? So if you look at the global financial crisis, and since you referred to that, I'll go back to it. And if you look at the credit cards industry in US, the credit cards industry in US actually has run the business very tightly between a 2% to 4% loss rate, right? And this has continued for the last 20 years, right? On good times, it goes down to 2%. Whenever there is stress, it goes up to 4%. So the profit levels are reduced, but does the industry become inherently unprofitable? No, the industry does not become inherently unprofitable. What we should keep in mind that between 2008 and 2010, and we are sitting in 2024 right now, the computing capacity, the information available with lenders regarding customers, and the power of the algorithms and the power of underwriting capability and the capacity to look data more granularly and making insights of the data, right, through computing systems have become an order of magnitude different. So systems are much more stronger. The sort of the credit administration frameworks are much more stronger. The regulators, having gone through multiple crises, are far more alert. Right. And this is not only in India, this is across the world, right? So, and the transmission of correction nudges is far, far faster, right? And the industry also reacts faster. And if you see in India, apart from, the sort of the informal system of that the banks and the NBFCs have set up together, sort of wrapped around by the bureau and the sort of the credit information system, the collaboration in the industry also is quite high. So I do believe that 2% on the long run is a good number, right? And if a sort of industry can keep the loss rates at 2% on an overall basis, I think it will be in fantastic health. However, we have to keep in mind that business does not move in straight lines. So given by the US experience, a little ups and downs will come in the trajectory of the business. But we should try to make an effort that on an overall basis, we don't try to breach that 4% number, right? Till 4%, I think, you are still within the safeguards. Above that, it's cause for concern.
Now coming to the company's efforts on the underwriting front. Now you've launched this project Cyclops this financial year, starting with the two-wheeler and then eventually building it to your rest of the retail businesses. What are you doing that other people in the market are not doing?
I don't know if other people are not in the market not doing or not, because I can't comment on that. But this is something which has been very sort of an intrinsic initiative for us. And because of my last 25 years in in retail assets, sometime around about 3-4 years back, we were just searching for how to make underwriting processes much more stronger and how to make sure that we underwrite customers more granularly, right? Obviously, with the customer concerned about what data sets that we use. So one of the things which was emerging, and this was my learning over the last couple of years, that because of the proliferation of UPI data and sort of every customer these days has a very thick digital footprint.
Correct.
Right? So that if you were to able to tap it to a certain extent, it can have valuable insights on the customer's affluence level, on the customer's stability levels, and the customer's overall creditworthiness, right? It can, and that's why I do not call it scores or anything like that. We call it trust signals or credit insights. Trust signals, whether you can trust the customer or not, right? So we sort of try to figure out whether we are able to build a one-pass credit engine that not only consumes the credit bureau data, it also consumes the liabilities data through account aggregator, and then if it can consume trust signals, right, some of the trust signals at scale, right, then the entire, on this 3 axis, the underwriting will become far, far more stronger. This was a thesis. We did some lab tests, as you know, before we started building the machine. We did some lab tests, and we figured out that this thesis holds. And we tried it on a set of our two-wheeler customers that we had, and we figured out that the separation is quite sharp. So we had to build this entire thing together. So we laid out the blueprint of that particular engine, and over a period of 3.5 months, some of our internal developers and credit risk engineers, as well as the data science team, as well as the credit risk team. In fact, there's a cross-functional team of 10 to 12 teams, right? They worked on this product and built it. So we have deployed it in a beta phase, and it's a machine that is working well. We have first deployed it for two-wheelers, because in two-wheelers, 40% is new to credit. It is very important. They have thin bureau or non-existent bureau. They have very thin liabilities, but some of them are doing UPI transactions, some of them, and we rely on something I call micro-geography in this particular exercise, wherein, we look at geographical intelligence as well. So the machine is performing well. In fact, our sort of loan eligibility rates have gone up. We are continuously hindsighting. So everything that the machine does, a human being also verifies. And we are hopeful that full-fledged deployment will happen on two-wheeler by sort of end of August, early September. The next product to go live will be Tractor. This is the Omni product. We call it Omni product, Omni credit engine, right? So it can do any product. It can do, and credit for any product. So we are hopeful that by the end of the year, we'll deploy it for personal loans, mortgages, SME, and loan against property. So we'll deploy it across all our products. It's a very highly resilient system. It can handle 100 transactions per second. It can, right now, it can do about 8,000 to 10,000, files per day. Right now, the capacity.
Okay.
And, we can add additional cloud capacity to push the processing volumes.
Up, yeah.
So we do believe that this is a next-gen system.
Yeah.
And this can help us build deeper moats in our lines of business.
Okay. Sort of side war, but this name, Cyclops. Now, the fact is that Cyclops in Greek mythology is a one-eyed monster.
Yeah.
And funnily enough, it suffers from depth perception because with one eye you can't really figure out how far something is. Why choose this name?
This name is primarily because Cyclops is a mythical creature,
Yes.
right? And it comes from Greek mythology, where this is a sort of a large, powerful beast which a omni-seeing eye.
Okay.
Nothing misses it.
Okay.
Right? Though it has one eye, nothing misses that eye. Right? It's very difficult to get past a Cyclops. So the allegory was that credit risk, you cannot get past Cyclops in terms of credit risk. That was the allegory.
So your algorithm is all seeing and it can't really miss
That's right.
potential risks factors. Yeah. Okay. One of the things that the regulator has said in the past is about algorithmic lending. Now, you said that you're not depending just on the algorithm.
No,
you have people verifying everything
Yes.
Before taking a decision. But how important is this human element?
See, this human element is very important. Now, obviously, right now we are 100% hindsight.
Yes.
But on full flow, right, so you have to use technology for productivity gains. Right? On full flow, we will not 100% hindsight everything. Right now, because it's new, we are 100% hindsighting.
Correct.
After it goes on full flow, a sample will be hindsight.
Okay.
Maybe a 5-10% will be hindsight.
Got it.
Always. It's very important to continue the hindsighting process. And also what we have done, see, because Cyclops uses right now, for example, for two-wheelers, it uses 16 scorecards. Right? Because for every line of trust signal or every line, for example, for account aggregator, there's a scorecard. For, bureau, there's a scorecard. For the trust signals, for each trust signal, there's a scorecard. Then you ensemble them together. There's a dealer scorecard. There's a fraud scorecard.
Right.
All this work in unison. So model governance is also very, very important. Now, what the Reserve Bank of India is warning against is that too much utilization of technology without human oversight, right, or without the adequate amount of human oversight can be dangerous. So what we are trying to build in is that get the productivity gains to using technology, but continuously build a practice of hindsighting, which is a human hindsighting of 5 to 10% of the applications, and build a very strong model governance team, which continuously looks at the models and sees whether the model performance is deteriorating or not. In fact, under our chief risk officer, we are now building a model governance team, right, whose only job will be to look at these models continuous basis and make sure that the models are giving the results as desired.
Okay.
So it's use of technology with human oversight.
I want to wrap this conversation up with two key questions. One is on costs and the other is on margins. Sure. They're linked, and I kept it for the end. But on the cost front, now, November of last year, the RBI comes out with the higher risk weights, where specifically they target NBFCs with high retail businesses, unsecured businesses also. How has that, affected the cost for the industry as well as L&T Finance? And how do you sort of counter it? And how have you countered it over the last 6-8 months?
Yeah, and I believe you're referring to the cost of borrowing because the risk-weighted RWA is going up, obviously, and with lending to NBFC affects our lending costs.
Correct.
I think what the borrowing cost. So what the team had very intelligently done in around 2022 was that they had, and in 2022 the rates were still low. Because after that the repo rate cycle, upward cycle started as inflation started going up, was that they had locked in long-term funds at much lower cost of funds, right? And so that has held us in good stead. If you look at our cost of funds, for this quarter, it was 7.85, which is only a 3 basis points sort of increase over what it was last quarter, which was 7.82. So that actually strategy helped to a certain extent to neutralize that RW increase by Reserve Bank of India. But as some of those loans get rolled over and refinanced over the course of the next 2 to 3 quarters, we expect that our cost of borrowing, our weighted average cost of borrowing would go up by anywhere between 10 to 15 basis points, right? So we're looking at 8% to 8
8.15.
8.05 or 8. Not maybe 8.15, probably between 8 to 8.05% is what we are looking at. What we are looking at. However, what we have done is that we have amped up now our PSL borrowings, right? Our parasitic lender borrowings, and commercial paper. Because commercial paper on the shorter tenor still has got a little bit of pricing advantage there. If you look at CP plus our PSL borrowings, we were at about 21% at the beginning of last quarter, and right now we are about 31%. So our team has moved there. We might be doing some retail NCDs during the period of the year. We have been also looking at ECBs as well. Our fully hedged ECB cost comes to about 8.4% odd. So yes, we are moving into sort of, as of now, our cost of funds have been stable and we have been trying to manage it, right? And we are hopeful that we should be able to manage it for the next couple of quarters, right? I do believe that food inflation remains high, right? Food inflation at 9% plus remains high, though the good monsoons augurs well for sort of lowering and tempering down of food inflation. And I do believe that as food inflation comes down on the back of a good monsoon, and US inflation also seems to be stabilizing, right? As and when the Fed rate starts moving its downwards journey, I do believe, and inflation stabilizes, and headline food inflation also moderates in India, I do believe that probably the downward rate journey in India should also start, right? But it's about hanging in there and making sure that your sort of weighted average cost of borrowing does not really go up too much for the next 2 to 3 quarters. And beyond that, I do believe that the downward rate journey will start.
All right, Mr. Roy, thank you so much for taking time out and talking to us. Absolute pleasure talking to you and discussing on so many different things. I hope this was worth your time.
Thank you. It's been a pleasure talking to you. Thank you so much.